We work with different municipalities. We go to different cities and towns and find a way to partner with them. And with that partnership, we work with them to build the project. And by doing so, like the city or the town actually invests real money and like real capital into the deal. So it lowers our basis day one. And then the remaining will just be raised from LP equity, just regular retail investors. We have not used any kind of pref or mezz in the past, and honestly don't plan on doing so, but that's typically what our capital stack is like.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. And on today's show, we have with us Justin Goodin. Justin is the founder and CEO of Goodin Development, a company dedicated to helping busy professionals passively invest in real estate development so they can live a life by design now instead of waiting until they retire. Justin, welcome to the show.
Thanks for having me on, Tim.
It is great to have you, and I am interested to learn more about what drew you to development deals specifically. But first, please tell us about how you got started in real estate and how you got to where you are today.
Yeah, of course. I got started in real estate back in 2018. And like most people, when you want to get started in real estate or get that idea that you want to get started in real estate, many people get started with fix and flips, rentals, and things like that. So that's exactly what I did. At the time, I didn't really know any better. I didn't know that there was apartment investing, ways to partner with people, ways to raise capital. So I started like many others and started fix and flips and rentals and things like that. Even like during like my college years. So I studied finance and supply chain management at a business school here in Indiana. One of these houses I was buying, it was from a younger guy, just like me, also in college, and not knowing anything about real estate. I asked this owner, why was he selling this property? And it's a single family house on the west side of Indianapolis. And he answered that he was liquidating all his assets to go in and invest in apartments. Now, like I mentioned, he was like a younger guy, also in college, very similar to what I was doing. And I was like, how is this younger kind of average guy going to go invest in apartment buildings? At the time, that was just like a mind blown to me and a shocker to me. But after that kind of instance, I just started listening to all kinds of different podcasts, reading books, watching YouTube videos, and really just like immersed myself into commercial real estate, started learning about apartment investing. And after graduation, I knew I wanted to learn more about commercial real estate and work in the industry. So I started working for a commercial bridge lender as a multifamily underwriter. So I did that for a number of years, which is a really fantastic experience for what I do today, seeing how banks underwrite deals, how they evaluate sponsors. All of that was like really helpful for what I do today. But long story short, left my W-2 job to pursue real estate full time and got into real estate syndications with larger apartment buildings. Acquired a little over 400 existing multifamily units. And last year, we have since transitioned into ground up multifamily development here in Indiana. So happy to chat more about that. But that's the, kind of the, long story short of how I got started in real estate and now do development.
Yeah, and not an unusual story. I would be curious to learn though, like when you started, because it sounded like you started pretty young while you were in school. And as most of us who have been college students know, that's usually not when money is most plentiful. How were you able to get the down payments for those properties that you started with the fix and flips? Did you do some kind of creative financing or was there something else?
Hard money loan, from private investors and my own cash. I was also working at the same time. This was before COVID, so when houses were really cheap. The first rental I ever bought was $44,000, if you can believe that. And this was a newly renovated flip that somebody was selling. So that was back then, 2018, a fully renovated flip was $44,000 on the west side of Indianapolis. So that was a down payment I just bought with my own money.
Oh, wow. That's just the idea of a house in general for that much it's hard to think about, hard to imagine. Yeah. But no, that's awesome. All right. You started, so many folks did, with the fixing and flipping. And what was your transition point there? You said you had the eye-opening experience of someone else who was transitioning themselves into the apartment side of things. And then you started to go down that rabbit hole that so many of us do, the podcast, the videos, everything else. And did you commit yourself at that point to getting into apartments? And if so, what was that transition period like? Did you have to offload some of the fix and flips that you had? What did that look like?
Yeah, I did start like offloading fix and flips and rentals and things like that, but I didn't like exactly get started in apartment investing right then. That was like the epiphany, like where I learned like how that was possible, like what drove me down like that rabbit hole. But like after that is when I started working for that bank here in Indiana as an underwriter. So that is like what really propelled me into real estate more. And as an underwriter, like you see everything. You see the borrower's tax returns, their balance sheets, their income statements. You see how much money they're making from these larger scale multifamily properties. So that like was like a look behind the scenes, if you will, and what really just drew me into the powerful benefits of real estate and more so like the larger multifamily side.
Yeah, and that seems like an amazing opportunity, right? They say if you want to learn a business, go work in it. And
Exactly.
you really did that. I don't think most folks who are into real estate or thinking about going into syndication, stuff like that, necessarily have the credentials to hop into something like that. So it sounded like a great opportunity for you that you were able to do that because again, you're behind the scenes, like you said. And I'm curious to know, I'm sure you learned a lot of things you should be doing, but you probably saw some of the things that some syndicators are doing that you learned were the wrong way to do business because you were like judge and jury back there as the underwriter for some of these deals. So what were some of the bad habits or the things not to do that you learned by going through so many deals that you saw come across your desk?
And yeah, like you mentioned, I was behind the scenes and working for the bank as an underwriter. I'm really like evaluating the risk for the bank
Right.
on these loans that they're potentially going to be lending on. So like I mentioned, at a bridge lender, this is back in 2019, 2020, when rates were extremely cheap. The whole time that I worked there, I never saw any loan that came across the table that had a rate cap on it. Back when rates were extremely cheap, all these bridge loans are being done. At least the deals that were coming across my desk and deals that I was underwriting, I never remember doing underwriting like any rate cap on these deals. These are all floating rates, recourse, bridge loans. I'm gone from the bank now, obviously, but I'd be curious to see how some of these loans and borrowers doing today with those properties. So that was a big learning lesson. Always put rate caps on bridge loans and have conservative underwriting. You never know what's going to happen in the future. You need to be conservative up front.
Yeah, and we have to admit some of that is hindsight is 2020, right? Because that wasn't the prevailing wisdom at the time. It wasn't, oh, hey, go ahead and buy a rate cap, even though it'll cost you this many hundreds of thousands of dollars, whatever it might have been at the time, because it seemed like an unnecessary expense.
Correct.
Rates could only go one direction, and that's down. Obviously, everybody knows that.
It was never talked about back then, correct?
Which is, one of those things. It's true until it's not. And once it's not, then it's pretty bad, especially when it comes to those bridge loans. And I remember I did one deal. This was a Tallahassee deal. And I think we were urged to get the rate cap. And we didn't think it was necessary like most, but we were like, okay, fine. I can't remember if the private equity kind of, forced it on us or if it was something that the lender wanted. But we did it because the other thing was rate caps were relatively cheap back then because no one thought they would be used, right? A rate cap can be seen as like almost insurance for if rates go up. And if you don't think you're going to need to call in that chip on the insurance, then insurance companies are willing to do it pretty cheap. And so for us, it was relatively cheap and it probably saved our deal, right? When it comes down to it. Because as soon as we hit that cap, I think it was 2%, then that starts kicking in and paying everything above that, which if we had to pay out of pocket, again, it could have crushed our deal, which I think we both know some deals did get completely crushed because they didn't have rate caps while taking bridge debt during that key period right there. So it's really interesting that you were able to see it. I mean, it would have been even more interesting if you were like still there, able to see how some of these deals shook out in the end. But I don't know, maybe some of the folks that you worked with and how they're doing, but certainly some interesting insight. And what would you say are the most valuable lessons that you took out of it? From the underwriting perspective, specifically, we always talk about, hey, be conservative. Okay, that's right. Like it's a great catchphrase and everybody says it. but what are some of the specifics that you put in when underwriting that show that you're being conservative?
Point. So you're right. The word conservative gets thrown around a lot. I really like to use the term like realistic, and I want to make the most as realistic as possible underwriting analysis that I can. So what does it look like? That looks under promising and over delivering. So that's projecting rents that are maybe slightly below what you think can actually be achieved. That way your whole deal isn't just highly dependent on achieving those higher rents. We can still work with lower rents. Like on a past deal we did, we actually projected a tax amount that was around 10% higher than what we expected when it was going to get reassessed. Little things like that, doing gradual increases to your income. So if you're going to plan on adding new forms of other income to the property, and let's take, for example, internet charge. If you're going to buy a property, a 100-unit property, all that is not going to happen day one or month one when you take over a property. All these leases that are signed at the property today are locked into that contract. And as a new owner, you will have to be able to gradually implement that internet income or that valet trash or that new form of other income. But you need to find a way to model that accurately and gradually in your pro forma, because that's going to take time to happen, and it's not going to happen in the first month. If you do model that way, it's just going to overinflate your projections, and you're going to be disappointing your investors.
Yeah, that's a good point. We don't often talk about the additional income aspect, and some people just plug it right in as if it's going to materialize all at once, and that's obviously
I see it all the time.
It's obviously not the case, with something like you said, with the cable, right? It takes time for those leases to turn over so that you can charge the next person that comes in. If you make it mandatory that they have it, valet trash, the same thing. There's other things like reserved parking spaces, right? Where it may be hard to gauge the interest. You can always do a survey of current residents, which, I'd say you should do to gauge interest, but even that may not be 100% accurate. And so you don't want to assume more than, you want, like you said, you want to be conservative and say, 10% less than what you think people will adopt on something like that. That makes a lot of sense.
One more thing, Tim. So like on interior renovation schedule, which obviously is really popular in the value add space, some operators don't project like this renovation timing schedule accurately. Again, like they'll project it too aggressive in the beginning, or think that these renovations are going to happen too fast in the beginning. A lot of people don't talk about when you're renovating the unit, it's going to take, depending on the scope, of course, it's going to take several weeks, a month just to get renovated. It's going to take more time for it to get released. But it's not going to move in day one, it gets renovated. It might take another couple of weeks for somebody to apply, get moved in, start paying rent. Modeling like that economic loss or that renovation downtime accurately in the beginning, I think is really key. Again, it's just another way to overinflate your projections if not done correctly.
Yeah, and one of the things I've seen over the past year or two where we've gotten, I'd say, I don't want to say gotten it wrong, but that has come in higher than projected are insurance and taxes.
Oh, yeah.
And you can get into this when it comes to development, because I'd be curious to know the impact that it has there. But at least for the value add multifamily space, in a lot of places, the taxes and insurance, I'm here in Florida, obviously insurance is a nightmare, especially when you have two hurricanes in a period of 1 month like we did this year. But those two expenses have been far above what was in pro formas, and that's obviously having an impact on the overall projections too.
Things like that aren't necessarily growing at a normal 2% inflation rate that some operators underwrite to. Taxes could grow 5, 8, 12% a year. Again, just goes back to being under promise and over deliver.
Yeah. And speaking of the development piece, you talked about how you transitioned over to that. What prompted that transition from the more, conventional commercial multifamily to the development side of things?
Yeah, great question. I would say the main reason that I switched my focus to development, and I'm a huge fan of being laser focused on one thing, doing one thing really well. So I transitioned my entire company and brand to only do Class A multifamily development here in Indiana. But to answer your question, a couple of different reasons. I think the main reason I switched is because the competition in the value add space is just so competitive. It's just so great.
Yeah.
Everybody and their brother is going after the typical value add mom and pop type deal. And I went like a whole year just trying to find my next acquisition. Like nothing was penciling out. I couldn't find anything worth buying. Deals from brokers weren't penciling out. Mainly just from competition and buyers overpaying, prices getting bid up. I made that decision to go into development because I think there's less competition in the development space and I'll be able to do more volume as a developer. Of course, there's tremendous competition in the developers doing the 200, 300, 400 unit properties and spaces like that. I'm focusing on properties between 50 and 150 units, at least like my next few acquisitions or projects. But yeah, to answer your question, competition in the value add space is just tremendous. So I think I'll be able to do more volume, more deals on the development side.
Right. And you mentioned that you're in Indiana. I don't know if all of your development deals have been there, and sounds like it.
Yeah.
Tell me more about that market, because that's just not a market that we've heard a whole lot about here on the show. So I'd be curious to learn more about it. And what is the pitch for Indiana as a lucrative multifamily development project investment arena?
One, Indiana in general is just very landlord friendly, very business friendly. Midwest in general has always just been a very stable, very consistent market to invest in. Indianapolis as a whole, we're in November of 2024. There was a market report that came out a few months ago. Indianapolis is one of the handful of cities in the nation that's still achieving positive rent growth, even right now in this time. So very stable, very consistent. Markets like DFW, places in Florida, Charlotte, all those are fantastic markets, right? Those do awesome long term. But you typically see like more swings in the fluctuations in the market and the economy. You just don't have those large shifts here in the Midwest and Indiana in general. But yeah, Indiana, very business, very landlord friendly, very stable. Indianapolis has a population a little bit over 2.1 million, several financial or Fortune 500 companies in Indianapolis. It's just been a great place to invest.
Yeah, that makes a lot of sense. Stability is very attractive. We have a deal in South Dakota, and it's not one of those markets I would have ever thought of before, but it is my most consistent and boring in the best possible way deal that I have. Consistent growth, consistently at 97% plus occupied, and there's no giant swings. It's great, and I love it. So I definitely see how that would be a plus. I'm wondering about like supply though. Is there a bunch of supply coming online within that Midwest area? Because I know that's been an issue in places like DFW that you mentioned, and then in Arizona as well, where those places that are hot, right? Everybody comes in all at once and tries to take advantage of that. And then all of a sudden, come 2024, 2025, they have a glut of supply. They're going to have too much, which is going to depress rents, occupancy, etc., all the stuff that comes along with it. I'm wondering what the picture looks like where you're at for that.
I've seen construction has definitely been down over the nation past couple of years, and deliveries are coming to an all-time low right now. Let's take my current deal as an example. We're developing a project now in Kokomo, Indiana. In the last A-class property that was developed was back in 2017. So we're starting our new project in Q1 of 2025. The last competing property was built back in 2017. So yeah, I haven't heard like any supply issues here in Indianapolis or Indiana in general. But yeah, it's definitely been growing, but I have not heard like any supply issue.
Awesome. And what do your deals look like structure wise in terms of hold time? Is this like 5 to 7 year holds, 7 to 10 year holds? And where are investors inserting themselves on these projects? Is it at the very beginning before you even break ground, or is it a little further in?
Great question. So we start raising capital when we have a deal that's been fully entitled, fully approved. Like we don't start raising capital in the beginning to acquire land or pay for civil engineering or architects, really putting that capital at risk before we know we have a deal. We use all of our own capital and money to do all the upfront work. And then when we have a project that's been approved and ready to go, that's when we fully announce it and get investors involved. Sorry, what was your first question?
Yeah, no, that's good. And, following up on that, what does that look like in terms of the capital that you have to commit to that upfront piece of doing all the, permits and land and everything else before you even start to raise on a deal, how much have you approximately have committed on those properties?
Honestly, just depends. I know it's like not the best answer, but so I have a unique relationship with some of my different third-party vendors. They are willing to do a certain amount of, let's just call it like rework up front, because I'm like really big on relationships. So like when I have a project, I'm not like bidding it out to all these different architects or GCs or civil engineers. Like I have a team, and I plan to use that same team unless there's a significant reason I need to look elsewhere. But yeah, since I have that relationship in that set team, they're willing to work with me to get these projects to the starting line. That involves some upfront work, some initial designs. It's a balancing act, right? But there's certain things we'll do in the beginning upfront for free as a good faith relationship. And then more so when we have a project, they're willing to postpone the majority of those costs until closing. So we try to minimize the cash coming out of our pocket as much as possible, and roll that to the actual closing date.
Yeah, and I've heard of some developers bringing part of the team in on the equity side of things. Is that something that you've done in the past?
Meaning what, Tim?
Like giving up some of the equity to the other folks that are working on the project, whether it's the construction, that side of things.
Yeah, I have heard of that, but I have not done that.
Yeah, I just think it's an interesting approach because then they have skin in the game from that perspective, but
Yes.
more so they have the incentive. So I don't know, it's just something creative that I heard that I was curious if you tried. But in terms of how the deals are funded, obviously you're putting up some up front. You talked about the other folks who are involved putting their work into it ahead of time. Are you involved with any private equity or anything like that?
No.
Up front in terms of funding?
No.
No, that's good. Not to say that private equity is bad, but obviously the less people that you have to bring into it, that reduces risk. You maintain control. So there's a lot of positive aspects to that. That's good.
All right. A quick rundown of what our capital stack looks like on a typical deal. Typically,
sure.
We have our construction loan that's on our past two projects that's come in around 54%, pretty low on the leverage there. And we have a sort of like unique competitive advantage. We work with different municipalities. We go to different cities and towns and find a way to partner with them. And with that partnership, we work with them to build the project. And by doing so, like the city or the town actually invests real money and like real capital into the deal. So it lowers our basis day one. And then the remaining will just be raised from LP equity, just regular retail investors. We have not used any kind of pref or mezz in the past, and honestly don't plan on doing so, but that's typically what our capital stack looks like.
Yeah, and can you explain that a little more? You said the city or the town invests in the deal itself. Are they like actually putting capital in, or is that in the form of like tax incentives, or what does that look like?
With the projects I've been involved in, they're putting real money into the project. Basically, with how interest rates are, with how construction costs are today, it's basically impossible to get a deal to pencil on paper unless the city wants to step in and invest in the project. We all know that. We'll just take a quick example. Like, it might cost us $10 million to build a property. After we pay our architects, the construction company, total project cost is going to be $10 million. And we know that all apartments and commercial real estate are based on the value of the income it's producing and the cap rate. Let's say because the rents of this property, when we go and cut the ribbon, it might be worth $7 million. Let's just say $7 million. The remaining of that $7 million will get 50% from the bank, 50% from investors. Between that $7 million and that $10 million is like what we call like that financial gap. Unless that gap is filled some way, the project doesn't happen. And so that's where we work with the different cities and towns to incentivize that gap. Otherwise, it's really difficult to get project defense out on paper. Now, of course, there are different strategies out there, building something cheaper, made of vinyl or like no amenities, a cheaper style product. There's just things like that. But a lot of different cities and towns, they don't want like that product in their area, at least if they're going to incentivize it. We're building something very luxury, A-class, high quality. And that comes at a cost, right? It's not cheap to do that. And so by doing so, it requires the municipality to invest in the project.
Okay. No, that's interesting. I just never heard anyone mention that before. So Yeah, I guess I'd like to learn more what those conversations look like on how you pitch local community leaders. And are you talking to mayors? Are you talking to city councils? Who are the people that you're most often interacting with for those kind of discussions?
Everybody you just mentioned, the redevelopment commission, council members, we are proposing a solution to them and giving them a compelling product to where they want to partner with the developer to make that happen. All these communities we go into, they want and they need a project like that. We're bringing jobs into the area. We're bringing housing into the area. All growth starts with housing. Businesses, companies, they're not going to come into a region or an area if there's nobody living there to benefit from that. So all the growth usually starts with housing. Like people have to live there to go to these different restaurants and businesses and work there. If there's somebody living there, the city isn't going to grow. Businesses won't come there. But yeah, to answer your question, it all starts with a simple conversation with the town manager, the mayor, council members, and just working towards the common goal of getting that project done.
Yeah, and for them, it's a development play. They could say that they're contributing to development within their area, providing high quality housing for workforce. It sounds like a win, but just a very innovative approach that we haven't heard here before.
Yeah.
All right. And talking about development projects, I think some investors hear development and they get a little skittish, thinking that there's more risk associated with development because you're starting from 0% occupancy. If you want to look at it that way, right? If they're thinking about it from the perspective of that more traditional value add multifamily investor. So first, do you agree with that assessment that development projects are riskier? And two, what are you able to do to mitigate some of the risks associated?
Say it's riskier. I would say it's just a different strategy, different business plan. There's certainly pros and cons to both, but yeah, I definitely wouldn't call it riskier. I say like the main thing that we do with our development projects that a lot of people are not familiar with is we do something called a GMP, or a guaranteed maximum price. So this is our contracted budget price that we go into an agreement with our contractor. And this is what we specify the project will cost. If it goes above that cost, the contractor is actually on the hook for the overage. So our GMP, or our guaranteed maximum price, is the price that we go under contract with. And if it goes above that amount, the contractor is going to pick up that overage. There's other hurdles that you can work into the contract with your construction company as far as timelines and things like that. If it goes over X months, the contracting company can actually start paying you because your opportunity cost is longer, you're paying interest on your loan, et cetera, et cetera. But yeah, there's some different staples you can put in your contract to mitigate that risk. Probably the first thing people think of is if you go over budget, what happens? But to save that, we have a GMP in the contract.
Yeah, that makes a lot of sense. And I know that would be a huge relief to most investors, right? Because that'd be their first concern, those cost overruns that can just happen, especially in environments like this where prices shot up significantly, whether it was for labor, materials. So I know that's something that's certainly going to be on the mind of investors. So having that safety net there would be huge in allaying some of their fears. All right, we do need to move on to the turbo round. So now I am going to ask you 3 questions that I ask every guest that's on the show, and I just ask for a quick, honest answer. You ready to go?
Right.
All right, first one. What is one red flag every investor should look out for?
One red flag, I would say if a sponsor, speaking from an LP perspective, if an LP is asking a potential sponsor about their background, deals they've done, et cetera, about their background, if they get like this feeling that the sponsor is trying to rush them or push them off or not answer their questions thoroughly, I find that as like a huge red flag. You want a sponsor that's going to tell you the good, the bad, the ugly, take your calls, answer emails in a timely manner. So I think if you get that like uneasy feeling when you're talking to somebody, just go with your gut, but that would be a big red flag to me.
Yeah, if you're getting that vibe, like nothing to see here, then that is certainly a red flag. All right. Second question. What is a myth about this business that you would like to set straight?
Myth. Let's go back to the floating rate debt topic. So I have never done floating rate debt. I've done fixed interest rate transactions on every property I've done, every deal I've done. But I think nowadays the floating rate debt is a big myth that it is super risky, and it can be, but I wouldn't say that all deals with floating rate debt are bad. Like they certainly have a pretty bad image nowadays. I haven't done a floating rate loan, but not say I won't in the future. But I think a big myth that is that they're all bad, they're all super risky. There are ways to mitigate that risk, and floating rate debt can be very powerful, a very, very powerful strategy. There's a number of very large, prominent sponsors that only use floating rate debt.
Yeah, and that's a really good point because so many people are scared of it.
Yeah.
Right now, people have to remember that markets are cyclical, and you have to take into account where you are in the market cycle, right? If you're at or near the top of those rates, then the likelihood is that rates will go down, not up. Is that a guarantee? No, of course not. There are no guarantees in investments, but it's a really important point that you have to take into account where you are in that cycle before you pass automatic judgment on whether something like floating rate is good or bad. All right, last question. What does success look like to you?
Yeah, success to me looks like having time freedom. I think that is the ultimate goal, the ultimate measure of success, just having time freedom, being able to wake up every day, like when you want, do what you want, not have anybody to do, or not have anybody tell you what to do. For me, that's like why I do what I do, and like what I'm working towards now, but having time freedom is the ultimate measure of success.
Yeah, absolutely. We hear that so much on here. All right, Justin. Hey, this has been awesome. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, thanks for listening. You can find out more on the website at goodindevelopment.com. On the homepage there, I have a free 7-day passive real estate investing 101 email course right there on my homepage. You can also follow me on LinkedIn at Justin Goodin.
All right, we'll have all of that stuff in the show notes. Justin, thanks again for coming on. And I look forward to continuing to see you do big things on your journey to multifamily millions.
Thanks, Tim.
Thank you.